I don't think that the technology is going to ever be able to generate the returns that the companies that are developing it are promising.
In your article, you also mentioned that if and when this AI boom bursts, it is going to be more like 2008-9 crisis.
I actually think that what I'm more worried about is a scenario, believe it or not, like what happened in 1929.
What really happened in 1929 and
called 1929, about the market crash a century ago.
1929 Wall Street crash was the most devastating in history.
So what is the clear piece of evidence you can say that the AI valuation and the investment that is taking place in these companies?
AI companies are spending close to $1 trillion this year. The answer is like everybody who has money to lend is lending it right now, it seems like, to the AI industry. I think that the overall chain of events will be you'll see the weaker players in the AI boom go first. The big model developers, OpenAI and Anthropic. But the reason was they announced that, OpenAI had promised to spend $300 billion, I think.
So let me get this straight. So you use AI in your day-to-day life, but still you call AI boom as a bubble.
I think that the main reason that it's a bubble is twofold. One,
Matt, thank you so much for your time. Thank you for joining me. And I would like to start with this. Do you use ChatGPT, Claude, or other AI tools?
I use Perplexity a little bit for source discovery because Google has gone way downhill over the past few years, and I have not. I often, frankly, struggle to find the links or and types of sources that I want to find using search engines. So
I
I
see.
used Perplexity, and I got a free Perplexity subscription through I can't remember who, maybe Comcast a year ago, like a free Perplexity Pro subscription. So I've used that. Um, there was a brief period where I tried to use kind of some of the more advanced features on Perplexity. At one point I like tried to get it to output a sort of like initial drafts of some ideas that I was floating around. But I was underwhelmed enough by the output that I stopped using it for basically anything other than research and source discovery.
I see.
Um,
So let me get this straight. So you use AI in your day-to-day life. You have a graduate degree from Ivy League. You have JD from Georgetown. So you are not Luddite or anything, but still you call AI boom as a bubble. Why is that?
uh, because I've read a lot about bubbles and crashes over the course of my career. First is basically it really started when I was getting ready to graduate law school. Um, when this was 2008, I was going into my last year of law school, and Lehman Brothers collapsed in September, and that kind of upended me and everybody in my law school classes' potential legal career. And I kind of wanted to know what was going on, what's going on in the global economy that is potentially wrecking all of our futures. And I started just kind of teaching myself a lot about finance and economics. I never got a degree in economics. So the way that I always describe it to people is that you'll be shocked by the things that I know, but you'll also be shocked sometimes by the things that I don't know. Um, but one thing that I did kind of voraciously read about is just, the history of how economic crises happen and how bubbles form. And the interesting thing is AI was not initially on my radar as something that I thought would turn into a bubble. Um, I first started getting interested in AI around 2015, and at that time, I guess you could call me an AI doomer. I started reading up on AI, and I read Nick Bostrom's Superintelligence, and I started to worry that we weren't taking the threat from AI seriously enough. But then I started to teach myself, having taught myself a bit about economics and finance, started to teach myself a bit about machine learning and computer science. And as I started to understand how deep learning and deep neural networks worked, and the architecture, and the underlying mathematics and the underlying computer science, I became less convinced, to put it mildly, that this was a technology that was going to lead to the sort of machine age that was being hyped up. And so I was like persistently surprised as I saw markets keep giving more and more money to AI companies on the presumption that, we were on the cusp of a fourth industrial revolution. So really, I actually have thought that we've been in an AI bubble since about 2019. And I just could not have I did not, I didn't fathom just how big I thought the bubble could get without bursting. Um, but I also know from my long reading of history that, you know, as John Maynard Keynes is said to have said, markets can stay irrational longer than you can stay solvent. Um,
Yes,
so, I think that the main reason that it's a bubble is twofold. One, I don't think that the technology is going to ever be able to generate the returns that the companies that are developing it are promising. And number two, even if they are able to do it eventually, I certainly don't think that they're going to be able to do it fast enough to pay the amount of debt that they've accumulated, especially over the past year to year and a half.
I see. So I'm going to come back to this, but I want to, you touch upon the history, right? So there were technologies like railroad and whatnot, internet as well, right? So in this technological development, railroad, internet, companies were previously over invested, then they busted, but the technology stayed. Do you think that will happen with the AI?
Not in the same way. And what I mean by that is, do I think that AI is simply going to evaporate off the face of the earth and we're never going to hear about it again? No. The technology is still going to be around. I do think that it will continue to be a major part of coding work going forward. I have my doubts about whether or not it will be a major part of, truly critical software engineering work. I think that even from my basic uh, introduction to computer science, I learned that if you don't write the code that you're trying to fix, you have a lot harder time fixing it.
True.
And I think that there's going to be a scaling problem as they try to incorporate vibe coding into more and more complex and sensitive types of software engineering projects. That said, I don't think it's the technology is not going to go anywhere. Um,
I see.
what I do think is the case is that the trillions of dollars that are being spent on Nvidia and the data centers that are meant to house and cool them are largely going to be lit on fire. And in that sense, it's not going to be like the railroads in the dot-com bubble, because even if um, even if the technology, let's say, achieves its potential and we have a fourth industrial revolution 10 years from now, that is about twice as long and maybe three times as long as the average lifespan of a rack of NVIDIA GPUs. And that's the biggest difference between this infrastructure boom and, like you mentioned, dot-com bubble and railroads. Fiber optic cable has a useful life that is measured in many decades. If you believe the fiber industry, it can last 100 years or more without being replaced. Railroads have a lifespan in the decades as well. So the infrastructural legacy that was left behind after the dot-com bubble and the railroad bubble burst, that was technology that was both not as subject to obsolescence and that had a physical life that is much longer than the assets that are at the center of this bubble. Um, so I think that what's likely to happen after the AI bubble bursts, you're not going to see a return on those massive investments in the infrastructure. And that's what gives rise to the possibility of real economic pain, even if people still are running AI models off of their laptops and phones and miniature models that don't take up a lot of, resources in the economy at large.
So what is the clear piece of evidence you can say that the AI valuation and the investment that is taking place in these companies, whatever company you want to name, that cannot be justified by future productivity increase?
Well, first off, I'll say that I don't have a crystal ball. I could be wrong about AI. It could be that they do return enough money in order to pay off their bills. But right now, um, AI companies are spending close to $1 trillion this year on AI related capital expenditures. But it appears, from what everybody can tell, that the revenue is somewhere in the tens of billions of dollars from generative AI products and services. I'm not talking about the money that is funneling through the system in circular transactions. There's a lot more
Yes.
if you count, for example, how much money OpenAI is spending on Microsoft Azure and things like that. But if you're talking
Yes.
about how much money businesses are paying and consumers are paying to access AI models, the number appears to be somewhere in the tens of billions of dollars. That is, roughly, in the low to mid single digits, probably, of what is being spent. And they are planning on increasing spending further, they being the big AI model developers and hyperscalers. They are planning to spend more next year.
Yes.
Um, and the revenue is growing fast, but not nearly fast enough to cover that gap. They're kind of pricing in they're assuming that we will hit essentially a singularity, that we will hit this point where AI's capabilities will either become so useful that people will be willing to pay $1 trillion a year collectively to access the technology, or that it will be so obvious that that's where we're headed that they will be able to get loans that will enable them to cover that amount. And that's kind of what they're already doing. They're borrowing so much money
Yes.
because they are not earning enough in order to pay the bills now.
Yes.
And I just don't see a pathway. I don't think that there's a pathway for them to ever, as I said, pay off those bills. And I certainly don't see them being able to ramp it up in the next 2 to 3 years, which is when a lot of these data center financing loans start to come due in 2028 and 2029.
Yes, you are right. And companies are borrowing in trillions, right? Right now, uh, you estimated that 7 trillion spending on data centers and other related infrastructure. So who is financing this huge amount of money?
Um, so I mean, I think that the way that Bloomberg put it in a story earlier this year is that it's all consuming or all encompassing. It was one or the other. The answer is, like, everybody who has money to lend is lending it right now, it seems like, to the AI industry. So workers and retirees are lending it to them through the issuance of corporate bonds that are being bought up by pension funds and mutual funds, and that have to have, or that don't have to, but that take a significant amount of their portfolios in investment grade corporate bonds. So I think that the last time I checked, the amount of investment grade corporate debt held by just the five biggest hyperscalers was somewhere around like 1.3 or 1.35 trillion dollars, and that
Yes.
is about double or triple what it was just 2 or 3 years ago. And that is just the debt that is on their balance sheet through these bonds. The other way that it is being financed, or the debt is coming from, is through private credit, especially, and this is the thing that there's a recent paper that dove deep on this, but especially life insurers are very involved in kind of providing these private credit financing arrangements and providing the basically direct lending to data center financing projects. And the way that that works is convoluted. Usually it's not the hyperscalers themselves. It's not Microsoft or Google or Amazon that's taking out the loan directly. Rather, there's a shell company that is taking it out on their behalf. And then the hyperscaler pays lease rent payments, essentially, or promises to pay rent payments in the future to them. But at the end of the day,
So,
it's the same thing. A promise to pay rent is the same as the promise to pay a loan back.
yes. So you mentioned a lot of things there. I need to unpack. So you mentioned a couple of
Yes.
things. So what is the difference between balance sheet financing and balance sheet financing? So could you please explain these two things?
Yeah. So, there's a corporate balance sheet, is something that if you are a publicly traded company, you release earning statements every quarter, typically. And on those earning statements, you have an accounting of what your assets are and what your liabilities are. And under your liabilities, you will have listed, this is the amount of debt that we have outstanding. And it's a headline figure. It's, the biggest one that people look at is long-term debt, which is essentially how much in bonds, do you have outstanding? And that is, that is the on-balance sheet debt, the stuff that shows up on those quarterly earnings statements that the companies are acknowledging, hey, these are effectively loans. That's what a bond is. It's a loan that you pay back by a certain date and you pay interest in the meantime. This is how much in those bonds we have outstanding. That's your balance sheet debt. That's typically when people say this is how much debt a company has, that's what they're talking about. But there are ways, especially in the kind of complex world of corporate finance, that you can take out loans without taking out loans, without putting it on your balance sheet. Now, whether you should be able to do that, that's a separate question. But off balance sheet debt is when you, instead of taking out the loan yourself, you do something like you set up a shell company. That shell company takes out a loan for $1 billion. And instead of, let's say that it's Amazon sets up this shell company that takes out $1 billion loans. And Amazon says, well, we're not taking out that loan, but what we'll do is we will promise to pay $1 billion in lease payments to this new entity that is a shell company that we have set up in order to use this data center that is being built. And technically, the loan sits on the balance sheet of the shell company. It doesn't sit on the balance sheet of Amazon. So the shell company, which is not a publicly traded company, and therefore they don't have to release their earnings statements every 3 months. They don't have to release them quarterly. And all Amazon has is this future lease commitment that they typically can kind of just, bury in their earnings statement as like a footnote saying, oh, and we also have these other obligations that, may or may not happen in the future because they haven't, the lease doesn't start until 2028. We don't have to put that on our balance sheet right now. And it makes it appear as though they haven't taken out a loan, even though in practice, they're still responsible for paying the same amount as if they had taken out the loan. It gets more complicated than that, even, because sometimes they have the ability to like pull out of the lease and they're not responsible for the full amount of the lease payment at that point. But typically what's happening then is that the shell company, they have some sort of loan from a bank or from a private credit company. And if the bank or private credit company doesn't get that full amount of the loan paid back from the shell company, usually the hyperscaler has guaranteed the loan, and so they'll still be on the hook for it. Uh, so that's kind of the way the long story short, it's kind of like you use these shell companies and these accounting games to have other entities take on the debt, but ultimately the hyperscaler is still responsible for paying it.
I see. I see. So why? So you put a number to these both borrowings, right? From balance sheet borrowing to I think 3 trillions. You put the number 3 trillion, and off balance sheet borrowing like 1.4 or 1.3 trillion dollars, if I remember, 1.65 trillion. Sorry,
Yeah, exactly.
right,
1.65
right,
for off balance
five.
sheet, 1.35 for on balance sheet.
So, why do you think? Is there any analogy? First of all, is there any analogy between um Enron financial structures, right? That serves the memory, and between these special purpose vehicles and AI boom. Do you think that is a right analogy?
I do. And I think that in a lot of ways, what we are seeing happen right now is that we're kind of uh, paying paying the price for not properly clamping down on this sort of financial chicanery that did bring down Enron, and that also played a major role in the lead up to the financial crisis in 2008 as well. There were a lot of banks that set up shell companies to, kind of hide some of their more toxic subprime mortgage related assets in the run up to the financial crisis. And what happened, for example, I think Citigroup, I want to say, had either 100 billion or 200 billion in shell companies that in loans that were off balance sheet through shell companies. And eventually, as the market started to crater, they were forced to acknowledge that they actually were responsible for those debts, and they had to take this massive hit on their balance sheets. Um, so I think that we are seeing a repeat of that, and there were lots of warning signs and opportunities in the aftermath of the Enron scandal and the 2008 financial crisis where we could have clamped down. We being, I'm kind of collectively saying as though I was in Congress at the time, but we as like a Democratic community could have clamped down on that stuff in the aftermath of both of those scandals, and we did not.
That's really tragic. But in your article, since you are talking about 2008-9 financial crisis, in your article, you also mentioned that if and when this AI boom bursts, it is going to be more like 2008-9 crisis, not like 2002 dot-com bubble. So I want you to explain to me, why do you think that it will look like 2008-9 global financial crisis?
So it's I actually think that I might phrase it a little bit differently. I don't think it's going to be exactly like 2008 2009. One thing that I always say, like, there's a saying in the military, the problem with generals is that they always fight the last war. The problem with discussions about economic crises is that everybody's always looking at the most recent crisis. They're always looking at the last crisis and that's their benchmark. Um, there are major differences between the current bubble in 2008 2009 that I want to acknowledge, and I'll give that tip of the hat to Corey Freyer of Consumer Federation of America, who I had a conversation with about this recently, and he helped me kind of crystallize and my thinking on this. um, right now, to kind of give the good news, the banks do not have the amount of toxic debt on their balance sheets right now that they did in 2008, 2009. So I don't think that this is all fours, like we're going to see the equivalent of Morgan Stanley today would be something, or sorry, the equivalent of Lehman Brothers would be like Morgan Stanley today collapsing or something like that. I don't think that that's what this looks like. I actually think that what I'm more worried about is a scenario, believe it or not, like what happened in 1929. And what I mean by that is what happened in 1929 was not that the financial system immediately collapsed. What happened was that the stock market crashed. It collapsed in an environment where the economy was already very reliant on wealthy, high net worth individuals spending a lot of money to keep it going. And when that engine stopped after the stock market crashed, it just kind of turned out that the economy did not have enough juice left afterwards to drive forward. And the economy just started kind of slumping. And but the slump, instead of like bottoming out and then rebounding, it just kind of kept slowly getting worse over the next 3 years. And the reason was like there had been too much exuberant spending and too many expectations built up that these profit bonanzas would materialize. And as it became clearer and clearer over time that the profits that people were expecting out of that company's champions were just not going to come anytime soon, the economy just kind of kept sinking lower. There's something called the wealth effect, and the negative wealth effect, which you were probably familiar with. But, the idea is that when people when people get wealthier, when they check their checking accounts and their savings accounts and their portfolios, they're like, wow, I have more money. I can spend more money. And they spend it more on goods and services, which makes corporate profits go up. They spend it more on the stock of the companies, which makes their share prices go up. But then when that stops, when it goes into reverse, all of those effects become a negative feedback loop. People feel poorer, so they start selling their stock because they need to, they see their portfolios going down and they want to move their assets into safer investments. They may even need to start selling the stock just to make ends meet if they over leverage themselves, which happens when you have a lot of consumer debt, which we're seeing right now. And that's really the scenario that I'm worried about, because there's more wealth tied up in the American stock market right now than there ever has been in the history of the country, and it's not even close. The last time I checked, the stock market was worth about 235 to 240% of US GDP. By comparison, at the peak of the 1929 bubble, stock market bubble, it was just over 100%, maybe about 115, 120%. And the all-time peak before the past couple of years was the dot-com bubble, when it was about 140, 150%, which Warren Buffett said at the time should have been like a blaring warning sign that things were too rich. And again, we are now 235 to 240%. So we're like way past that. So the what I'm worried about is that it's not that there's going to be this sudden snap of the fingers, Lehman Brothers is going to collapse tomorrow sort of thing. But that's not how crashes usually play out. There's this long period where there's like the economy's kind of in a shaky state. And my fear is that this time there are so many ingredients in place for the economy to get worse and worse and worse without really any countervailing things that can rescue it. That if there's an AI crash and it becomes clear that trillions of dollars worth of chips and data centers and things like that are just not going to become economically productive assets, that's going to create a sort of drag that's going to really just lead us down a very dark path economically.
Oh my God, that's very gloomy picture. That's very gloomy picture. But you're right. You're right. But what do you think that specific chain of event or specific chain of contagion will happen if such a dark phase or gloomy phase starts to unravel?
So I don't know what the very first step will be. And to be clear, like this is one possible future. But I think that the overall um, chain of events will be you'll see the weaker players in the AI boom go first, followed by I think you're going to see distress with the hyperscalers and Nvidia. And from there, that's when you'll start to see the broader effects on the economy. It'll go through life insurers and private credit. And just to kind of rewind, I think that the companies that are most at risk of going first would be the big model developers, OpenAI and Anthropic, um, which are just, they're spending far more than they're making. I know that Anthropic said that they made an operating profit earlier this year, but um, by pretty much all accounts, that's because they're kind of like almost ignoring the cost of training their models um,
Yes.
and ignoring a lot of the money that they have to pay to vendors for certain services that they probably should be counting. They're still losing money, and they're still losing a lot of money as far as like on a cash flow basis. They have a lot more money going out than coming in.
True.
And the I think that the neo clouds, so companies like CoreWeave and Nebius and Crusoe Energy, they are very highly indebted. And it, certainly if a company like OpenAI or Anthropic were to go under or struggle to make its lease payments, they would be in a very tough spot. But even if that doesn't happen, the mere existence of data center construction delays and problems bringing data centers online fast enough could get them to go. And then Oracle is the other one. Oracle has, more debt relative to its, assets and its revenues than probably any company that is involved in this. Um, and the problem is all those companies that I just mentioned, the model developers, Oracle and the neo clouds, they are so tied up with the hyperscalers and Nvidia through all of these
Yes.
circular financing arrangements that I think people are kind of over. A lot of people are a little bit too complacent about the possibility that the collapse of those weaker players could bring down the stronger ones. A
Yeah.
year ago, I think that they probably could have survived it. Now I'm very doubtful. Like, they would need. I think that there was a story that just came out today that said something like um, 50 to 70% of Microsoft's AI revenue comes from OpenAI. Um, so like it's not as though these companies have these standalone streams of revenue from generative AI products and services that they are selling that they can use to pay off the debts that they have racked up. And as much money as the hyperscalers make, they do not have $3 trillion worth of cash flows to pay off these debts if OpenAI and Anthropic aren't good for it.
I agree. In your article also, you gave reference to this beautiful diagram where you talked about the circular flow of capital. I think that's one of the best piece of evidence on this particular argument I have seen. So, can you give me another example? You mentioned Anthropic, OpenAI, and another company. So can you give me a concrete example where two companies are so intertwined that even if the smaller company fails, it is going to take down the bigger one with it?
Yeah, I mean, the most obvious example would be OpenAI and Oracle. Like Oracle has, if you want an extreme example, that's it. I think that half or more of Oracle's expected future revenue comes from OpenAI. So what you may recall, Oracle's stock just skyrocketed one day last September. And Larry Ellison, for about a heartbeat, was the world's richest person. And but the reason was they announced that OpenAI had promised to spend $300 billion, I think it was, with Oracle over the next few years. Now, Oracle didn't just take that and say, "Hey, great, we're gonna take this money and distribute it to our shareholders." No, they went out and they took out a lot of money in loans, and those loans, most of them are not 30-year bonds. They are loans that need to be paid back within the next 5 to 10 years. And if OpenAI does not earn hundreds of billions of dollars in revenue to pay that off, Oracle is toast. They are done. Now, other companies, it's not that extreme. There aren't other examples. Microsoft and OpenAI is maybe the closest, but you don't have other companies that are so dependent on just one company providing so much of their revenue. But if you look at those charts, the sheer quantity of the circular deals that have arisen between these companies, you add them all up, and you do have that. There is enough money that is kind of contingent on OpenAI, Anthropic paying their bills, that's contingent on the neo clouds completing their data centers on time and within budget, where if those things fail to happen, these debts that the hyperscalers have accumulated become really hard to pay off. And yeah, so but for one example, I think Oracle and OpenAI is probably the best.
So, so you're talking about these overly dependent companies on each other, right? So let's say if this worst case scenario happens, who is going to hold the bag? That's the most important question, even in the 2008-9. In terms of, not just in terms of companies, but in terms of, in general, investors, let's say banks or these institutional investors or pension funds, who do you think will be at the receiving end?
So I don't know, and that is maybe the scariest part of all of this, is that the financing that has arisen from all this has become so complicated and convoluted that it's hard to really draw a direct line and say, if everything goes south, this is where all of the liabilities will ultimately land. I think that the hyperscalers can absorb a lot of it, but there's a paper by I want to say Wachter, two different people named Wachter, Wachter, that came out a few weeks ago that kind of like sketched out different scenarios of how much revenue that would need to be generated in order to, for the hyperscalers to pay off their bets. And there's a certain point past which they're not able to, and they're insolvent. And at that point, where do those debts go? Well, it falls on the people who hold their bonds, which is not primarily ordinary retail investors. It does include a lot of ordinary people's retirement accounts. Where a lot of it has landed recently is with insurers, life insurers, and pension funds. But what those companies have especially taken on is a lot of the really, really risky debt, the debt that's been issued by the neo clouds, the debt that's been issued by these chip-backed loans that have become popular. And I do want to actually pause real quickly on those. Like, there's been this very quick rise in loans where the chips, AI chips, serve as collateral. And the problem with that is that if there's a crash that prevents, say, OpenAI or Anthropic from paying their leases, and therefore that's why the company that took out that loan is not able to pay off the loan, probably those chips that serve as collateral have become a lot less valuable. So whoever holds that loan that was saying, "Oh, it's fine if at the end of the day, if the company defaults, because we can just sell the chip and get the money from the chip." But if the chip has become close to worthless, which I honestly think is a possibility. Again, if there's like a sudden stop to this data center construction, or if it dries up quickly, Nvidia's already manufacturing chips that are going to be, that are a generation or two ahead. Nobody's going to want to use the old chips, that are in the data centers right now once those are ready. So you could have chips that are very, very not valuable. And then whoever holds those loans, whoever was the lenders for those loans, is stuck holding the bill. And who that has become increasingly is life insurers. And that is a very scary prospect because, number one, because obviously a lot of people rely on life insurance to pay their basic expenses in hard times. But number two, life insurers play a really important role as intermediaries in the financial system. You may recall that in 2008, AIG, which was like a big insurance conglomerate, they were kind of imminently about to collapse, and everybody kind of realized that if AIG collapsed, that we would have a financial crisis, that might spiral out of control. So life insurers are really getting exposed more and more to this very risky debt. But it's hard to say exactly how much because, again, these transactions have become so convoluted. A lot of it is happening through shell companies and through companies that are privately held, so we don't have information on who exactly is in the chain of liability if the loan doesn't get paid off.
Yes, I agree. I attended a conference last month, and that was the whole point of one of the presentations, that many of these insurance companies are at risk, and there is a serious possibility that AIG kind of crisis might come up. That's where I want to come to what happened in 2008 AIG crisis, when regulators realized that, hey, the whole world is going to crap, we must come in, right? So in this case, in this particular article, you argue that this is the right time for regulation, but Washington is moving in the other direction, that we are deregulating precisely when we should be regulating. So who do you think should be in charge of this regulation? SEC, or Federal Reserve? Federal Reserve have another issue that I want to come. They are trying to shrink their balance sheet as well, right? So first of all, who is responsible for this regulation in your view?
I mean, I think that one of the issues is, if you ask me, it's kind of crazy that the way that financial regulation works. For something that is so important, it's kind of crazy that we don't have a unified single financial regulator, regardless of whether it's the Federal Reserve or a single entity. We have this balkanized system of regulation where you have the SEC dealing with securities, and the Office of the Comptroller of Currency dealing with the national banks, and the Federal Reserve also dealing with different aspects of the banks, and the FDIC dealing with depository institutions. And it makes it extremely difficult for any one regulator to step in and get a full picture of all of the risks that are involved. So if this, what really needs to happen is a level of cross-agency coordination to kind of pool resources and say, hey, who is it that has the authority to collect this information? And in some cases, the answer is going to be, I think that the number one entity that is in a position to do it is the Federal Reserve. Because after the last financial crisis, especially with, I'm forgetting the acronym, but it's not the Financial Stability Board, it's FSOC, the Financial Stability Oversight Council. They have the ability to designate certain institutions as systemically important, so that the Federal Reserve can regulate them regardless of whether the Federal Reserve can kind of inquire into them at the very least, even if they wouldn't ordinarily fall under the Federal Reserve's jurisdiction as a financial institution. this would be a great time for the FSOC to start, inquiring into where are the key pain points in the economy, and which institutions the Federal Reserve does not have the ability to inquire into. Can we give that designation to, so that we can start collecting the information we need? So I mean, I don't think that it is, though, any one entity. I think that the Federal Reserve is probably the one that needs to take the lead. But the other thing is that I am very, very aware, again, from reading history, is that when you start getting to the end of a boom phase and it looks like it's about to turn bust, uh, the problem is everybody fears that downturn. They want to avoid it. And so the problem is that in order to kind of prop up an unsustainable boom, you end up taking steps that makes it even worse. And that is what I think it to some degree is already happening, again, with the examples that, my article mentioned of, we're opening up additional, we're opening up retirement accounts to invest in private funds. We're there's potentially going to be lower capital requirements for the banks. I think that there actually are going to be lower capital requirements for the banks, which is the sort of thing you want to do when you want to keep a boom going. And that makes sense if you think that when you come out on the other side of this, that there's going to be more profits available that will allow you to pay all of that down. The problem is that if that hypothesis is wrong, which I think it is, I don't think that there is a pot of gold at the end of the rainbow to be had with all of this. Then what you're doing is you're setting yourself up for an even bigger crash when it all goes down.
Yeah, and that's why one of your recommendation is we should say no AI bailout, right? But do you think that it is possible in current political situation that we are in, the administration, the treasury, and everything?
I mean, I have no doubt that they will try a bailout. I honestly do worry that it's already gotten to be that the amount of assets that are tied up in the system and that are at risk now is already so great that even if the federal government decided to try a bailout, they could not allocate enough money to actually pull it off. I you know just to use as an example, again, the top I believe it is 10 companies by stock market capitalization right now are all AI focused tech giants. Their paper valuation is somewhere in the range of $25 trillion. There's been it's changed a bit in the past couple of days. It might actually be a bit higher. Right now, also, the S&P 500's the CAPE ratio, the cyclically adjusted price to earnings ratio, is around 42. That is about 2.5 times its historical average. So if stocks were, forget like a crash that actually takes them down to below that historical average, if we were to have a stock market crash that were to wipe out enough of those valuations to take the S&P 500 down just to its long run average of about 17, that would wipe about $15 trillion plus of paper wealth off of people's portfolios. Now, that is not enough by itself necessarily to send the economy into a recession if there were no other problems in the economy, which there are. But my point that I'm trying to get across is the federal government does not have the capacity to make up for a $15 trillion shortfall in people's portfolios. Like that is more than that is about half of US GDP for a full year.
Yes.
And so it's not even part of the reason that I'm so focused on no bailouts is that all it would be doing is throwing good money after bad. This is not something that you can prop up and come out the other side okay. This is a matter of there has been speculative spending that it will either pay off or it won't. I don't think it will. And the risk that you take if you try to double down on a bad bet is that you just end up throwing good taxpayer money after bad investor money.
And yeah,
Um, and on that note, I'm, I don't know if you followed what happened in South Korea, over the past week or two, but they had kind of a very, very intense stock market crash over the past few
yes,
weeks. And one of the things that stopped it was, or one of the things that helped stop it was the government announcing that they were injecting more money into their sovereign wealth fund, into South Korea's sovereign wealth fund, in order to basically buy AI related stocks,
yes,
which great, that stopped the market for now. But are you going to keep doing that every time the next time the market goes down? Again, like the assumption behind this is that, but behind that sort of backstop, that was a quiet bailout by the South Korean government.
yes,
The assumption behind it is that eventually that AI is still going to be the economic future, and that if we just pay a little bit more money, we can tide things over until real revenues show up. But if you're wrong about that, then all you've done is you've thrown more of taxpayers' money into the black pit.
yes. And another issue is right now, as I mentioned, the Federal Reserve is trying to shrink its balance sheet. And if there is such a scenario where bailout happens, who is going to buy the government debt? Because that's the only way to inject money into economy at this moment. And who is going to buy? Federal Reserve. So I think it is going to have another effect on the monetary policy, another shock to the balance sheet of Federal Reserve. That's another issue to this.
I think that's right. And more generally, like, the United States is not the economic overlord of the of the global economy that it was in 2008 or 2000 anymore. There is, both in the sense of, China has become kind of a rival as far as just the sheer heft of its economy, and but more importantly, like, there's just a lot less faith in markets, in the US's long-term economic reliability. And we saw that with the reaction to the Liberation Day tariff announcements, when bond yields, usually what happens when markets are going haywire is that people pile money into government bonds and their yields go down, and instead yields went up because people were worried that they didn't want to be too exposed to the U.S. economy. And we saw that a little bit more when the Iran war happened. There was actually a greater increase in demand for Chinese bonds than there was an increase in demand for U.S. bonds. So if there's a true economic crisis that originates from what was thought to be the engine of future U.S. economic growth, the assumption that the usual economic policy toolkit of open markets operations by the Federal Reserve, I'm just not sure that that does the trick. And that's kind of also the parallel with what really made the crashes of 1929 and 1873 get as bad as they were, which was, you know, the policymakers in each of those crashes had in their heads, here's what you do in a crisis. You stop lending, as much money. You kind of get your finances in order, and we're going to go to the gold standard, and we're gonna rely on that to get a core of the economy going again. Now, again, we're not making the same mistake now. I'm sure that we will try to stimulate the economy rather than restrict the money supply. But there is a parallel in the sense of where we are assuming that the usual toolkit for responding to economic crises will work in the same way that it has in the past. But there's a certain point past which the crisis becomes deep enough that that toolkit is no longer as effective, and might even be counterproductive if again, like the issue is that people are just don't have as much faith in U.S. assets, and then you flood the market with more U.S. assets, that it could actually make things worse.
That's true. That's true. But let's end with policy recommendation. Give me 3 policy tools or policy levers in this case right now you will employ as a uh, say regulator, Federal Reserve, anyone. What 3 things should a regulator do right now to make sure that if there is a damage, it will be minimum?
Yeah, I mean, I think that the first thing is, like I said before, I think that the various financial regulators need to start having huddles and figuring out how it is that they can use their discretionary authority to kind of demand more information about financial institutions' exposure to a downturn in AI, a downturn in AI assets, and what happens uh, if bond prices for a lot of the data center debt takes a hit comparable to the hit that subprime mortgage debt took in the run up to the financial crisis, and how does that ricochet through the system? How does that affect everybody? That's step number one. Um, Number two would be to reverse. I this is obviously not something that I expect the Federal Reserve to actually do, but I think the capital requirements. This is the time to raise them, not lower them. I think that you need to make banks' balance sheets more resilient in the case of a downturn right now. That's the simplest thing you can do. If you provide people with confidence that, hey, yeah, there's going to be, even if there's a crash in the AI sector, we know that the biggest banks are going to be good for their obligations. And we know that the basic plumbing of the economy is going to happen. That's what, it's a blunt instrument, but that is what capital requirements are meant to do.
Yes.
And then the third thing, I really think that there needed to be greater consideration to um, we need to have a better plan for what happens if financial institutions do start to fail. I don't think that the Dodd-Frank Resolution Authority personally is it, it's not robust enough to handle kind of a truly systemic crisis where a bunch of institutions are on the cusp of are facing acute crises simultaneously. If you read the Dodd-Frank Resolution Authority, it was meant for what happens if one big bank
Yes.
approaches insolvency, and what do we do about that? But realistically, that's probably not what. If one big bank is approaching insolvency, they're probably all approaching insolvency. Um, and there's multiple options that scholars have talked about for how to deal with that. You could have some form of like speed bankruptcy where you just basically make unsecured creditors the new shareholders instantaneously. Or you could have a system of, government receivership for, systemically important financial institutions that's like an automatic backstop. But the reason that that's important is that if you don't have those things in place by the time a crisis hits, then what the banks are going to say is you have no choice. You have to bail us out.
Yeah. That is the worst case scenario we have learned, if we have learned anything from the last crisis. But thank you so much, Matt. This is very informative. This is an eye-opener conversation for me. Thank you so much.
Thank you for having me.